Welcome everyone. So for those who did not attend last week, my name is Ethan Lee, and I'm a rising senior at Bellevue High. Over the next 6 weeks, or now 5 weeks actually, we'll be going over some of the basics to trading fundamentals, including technical analysis and fundamental analysis, which we will be going over a lot today. So first, I just want to make it really clear, what's the whole idea of the stock market, right? So a lot of people get this really confused. People confuse exchanges with indices or the plural form of indexes, right? So the S&P 500, they think that's an equivalent of the New York Stock Exchange. So what you see right here, if you could see by the logo, this is the New York Stock Exchange. So you've likely seen this in movies or documentaries, but this is where a lot of the floor trading occurs. Along with the New York Stock Exchange, there is the NASDAQ. These are two different exchanges. I believe in the United States that there are approximately 13 exchanges, and the New York Stock Exchange and the NASDAQ cover about 6 of those, actually. Yeah, so what is the stock market? So the stock market is a platform that buyers and sellers selling stocks, can conduct their trades. And these stocks represent ownership claims to businesses. So as I mentioned, some of the popular indices based on stocks from US exchanges include the S&P 500 or Standard & Poor's 500, the Dow Jones Industrial Average, and the Russell 2000. So each of these kind of have their own little segment or group. Like a lot of people say that the Dow Jones covers a lot of technology stocks. These are about like the top 30, or not really the top 30, but 30 very large companies listed on United States exchanges. So if you look at headlines on the Financial Times or any newspaper service from a financial institution, you will see them mention all the time that the Dow, plummets like 3,000 points, right? So we'll get into that in the next slide. Okay, so a point equals $1, but that's only when speaking about individual stocks. So let's say that IBM dropped 5 points. So that would mean that the IBM share price dropped $5. However, when we're talking about indexes such as the Dow, 1 point is not necessarily equivalent to $1. So when they say that the Dow plummeted nearly 3,000 points, it does not mean that the Dow Jones Industrial Average, fell almost $3,000. So the one-to-one ratio, that was kind of a thing of the past for indices. Except now we're thinking of them more as in points. So if you become an avid trader, you'll kind of see these points as relative to a certain amount. You could just track this based off of the proportions of 1 point to the drop itself. It's very inconvenient to say, for example, the Dow plummeted $693.80, give or take a few thousandths of a dollar, right? So they would just say the Dow fell 100 points. Yeah, so the whole idea of a point is just for simplicity, especially when talking about specific price drops. Next, here's just a picture of the charging bull. So if you've ever been to New York City, you've likely been to Wall Street, and the charging bull, which they always move, it's right here. It's a popular tourist attraction, right? So what a lot of people think is that the charging bull is just a representation of how strong the US economy is and how notorious it is. In reality, when we're talking about a bull, especially when we're talking about financial markets, we're talking about an upwards trend in price. So I'll get into this into the next slide. But what I also want to mention about Wall Street and finance is that I don't want to get too political with this, but there are a lot of people who say that Wall Street bankers are fraudulent and that when the economy is booming, the people who benefit the most are the rich people, or the bankers perhaps, and the investors. The thing is that, I mean, it's partially true, but the reality is that rich people can get rich either way, whether the price goes up or down. They can hold positions on either side, meaning that they can go negative or short, or they can go long or buy into those stocks. So basically, whether the economy is booming or dragging down, they're making money. So yeah, there are 6 different specific market climates, and your trading and investing strategy has to be different for each market type. So a lot of people, they come up with a trading system that only applies to one specific market climate. So market climate, or market type rather, is determined by 2 main factors, which include price direction and volatility. So obviously by the name, price direction suggests the relative movement, which can be up, down, or sideways of a price in a time interval. So like when a price is going sideways, there's no particular trend as to whether it's going up or down. It might be going up and down very quickly, and there's no particular trend that you can draw out. For volatility, that's kind of measuring how turbulent the market is. So like the high volume of trades. So what you will see when we're getting into chart analysis later is that when you hover over a candle or a specific interval of time, you will see an indication of volume. So this suggests, or this tells you how many shares of this security or instrument has been traded in that specific interval of time. So a lot of people, they only think about price and price movement when they're thinking about stocks. What you also have to pay a lot of attention to is the volume or volatility. So besides a bull, which is an upwards trend, when the price is moving down, we consider that a bearish market. And as I said earlier, when it's not moving in a specific direction, it's moving sideways. So moving beyond just the price direction, as I mentioned, volume is very important to recognize. So when it's high, we consider it volatile, and when it's low, we consider it quiet. So if you take in math, right? So there's 3 different sort of directional components, while there's only 2 for volatility. So based off of that, there's about 6 different market climates specifically. So as we can list off here, there's the bull volatile market, the bull quiet, the sideways volatile, the sideways quiet, bear volatile, and bear quiet. So this can really vary from time to time. It's not going to be bull volatile one day and bull volatile for the rest of the month. That's not really true. So when we're talking about market climates, we're talking about a specific indicated portion of time or interval of time. We cannot just say, oh, we can say we are in a bull market right now. That might suggest that maybe for the past few months, we've been seeing constant increase in price. You could say, what you would say if prices are just increasing temporarily, we could say that it's bullish, right? So we're not going to say we're in a bull market, but we're bullish right now. The share price is bullish or bearish and sideways. Yeah. All right, so as I mentioned here, the 6 different types of market climates. Here you can kind of see the bull volatile, as you can see in the top left. There's huge increments. Of course, there's a few red candles in there indicating price drops temporarily, but overall, there's huge increments over that specific period of time. Around the same amount of time, however, you could see in that same graph portion that there is sort of a lesser slope to the increment. We would call that a bull quiet, meaning that there is less volume. So how do you know if it's less volume? Well, what you have to understand is that the share price is determined by supply and demand, right? So if a lot of people are buying a stock, this will drive the share price up. On the other hand, of course, if they're selling the stock, a lot of people are selling the stock, a lot of shares are being released, then the price will go down, right? So this is all a matter of supply and demand. There's not one person who's determining what the appropriate share price is, right? Yeah, and then moving on to sideways volatile, we could see that there's no really particular trend to where it's moving. I mean, we could see that there was a huge drop at around the second candle. It moved up a little bit, but then it went back down again. So there's no really noticeable trend here. We would call that a sideways volatile market. Here we could see a sideways quiet because, as you can see, just like the previous graph, there's no really noticeable trend, whether it's going up or down. It goes down and then back up, down and back up. So yeah, we don't really know what's happening here. But as you can see, the candlestick bodies, which we will go into, are much smaller than the ones than the chart on the left. Next, we have the bear volatile. As you can see, there's much bigger drops, the candlestick bodies, and it's very clear that there's a downwards trend. For the bear quiet, however, you could see that there's a smaller slope. All right, so now we're going to dive a little bit deeper into charts. You'll find later that when we're doing all sorts of analysis, price analysis, volume analysis, charts will be your very best friend. Other than just looking through ratios and statistics, charts are a very good method in visualizing patterns. So if you become a pattern day trader, so that you trade a lot, you'll start to notice patterns in charts that might not be academically listed out in academic sources, right? So charts are kind of your way of interpreting stocks. In terms of the knowledge that is required for charts, once you get to a certain level of trading, almost every trader knows the different types of patterns. Where you have to come in, though, is your mental fortitude, your sort of trading psychology. That's the most important when trading. Yeah, so at the top, we have a line chart. The line chart is usually used by longer term investors. That's solely due to the fact that the line chart only shows the closing price of this of each share in each day, right? So you could select the time interval in which you want to see a plot, a pointed plot. So for example, at each of these points, it's 1 day, it's the closing price of 1 day. So you're not going to really see the highs or lows within that day. You're only going to see the closing price. So why do the investors only care about that price? Well, they're going in it for the long run, right? So they don't really care about how much they move within one specific day. They only really care about the trends, the overall trend, like where is it heading? So if you look below the bar chart, it's really unnecessary for long-term investors to take a look at something like this. We're not going to really go into bar charts, but just as a side note, if you look closely into the bar chart, you'll see two lines protruding to the left and right side of the long line body. So the little line on the left is the opening price of that day, or of that time interval, and the line protruding from the right is the closing price. So of course, if the closing price is higher than the opening price, the bar will be green. Vice versa, and that will become red. Lastly is candlestick. So the candlestick chart is the most important for traders, specifically day traders as well. Candlesticks, they could tell you everything, which we'll be getting into over the rest of the lecture actually. But there's a lot of different patterns that you need to recognize with candlesticks. And in terms of functionality between bar charts and candlestick charts, they actually serve the same function. If you could tell, these are all of a graph of Amazon recently. So they all look the same in terms of relative movement. I mean, of course, it's during the same time interval for the same security. But as you can see, it's much easier to visualize the drops, especially when you see the big bodies of the candlesticks. Yeah, so as I said, candlesticks are a trader's best friend. So as I said, also line charts are used by longer term investors who mostly care about the closing price of each day, not including the opening price or the high or low. So yeah, bar charts do serve the same functionality, but they hurt your eyes to look at too long. And it's a little bit more difficult to see the patterns that we'll get into. So for those of you who don't know how to sort of translate candlesticks, if you could see here, the top part of the line, so not including the body, that's the high of that specific time interval. So let's say that this was a day. Each candle represented a day. The high would be the topmost part of the line. The close would be the topmost part of the body. The opening price would be the lowermost part of the body, and the absolute low in that time interval would be the lowest part of that line. In contrast, as you can see, the opening price is higher than the closing price, suggesting a downwards movement in that time interval, which would make the candlestick red. So the red and green, as you might guess, indicate a movement of up or down. Conventionally, or actually not conventionally, traditionally, these candlesticks were colored in either white or black, but these days, for most actually, trading platforms, you will see that charts are represented, or candlestick charts are represented in green and red. All right, so now we're going to get into some of the indicators and patterns that candlesticks can show. These are actually very important to know, so I would suggest getting out a notebook and a pen or pencil if you have one. We'll also get into this a lot next week, so I would say that this week's lecture and next week's lecture probably going to contain most of the knowledge that many people do not know. So this is not going to be any theory or anything. This is just solely stuff that you should know as a trader to start recognizing patterns. And of course, recognizing these all comes with practice. All right, so first we have a shaven bottom, right? So the shaven bottom shows up after a bearish or downwards move. So as you might think, after a stock price or the stock price has moved down, it's likely to have gone up at some point. So if you look at any graph, you've probably seen one of these at the bottom of that downtrend. So what does this really mean? So as I said earlier, the stick kind of represents the absolute high and the absolute low. But as you can see, the absolute low is the same as the closing price, right? So that kind of indicates that during that specific time interval, the very minimum share price is the price that it ended off at in that time interval, right? So you might interpret that as just, oh, right, I mean, it's just a coincidence, right? Well, it also suggests that the stock price is kind of congested at that point. It's kind of deciding to start moving up. But as I said, the stock price is not really ambiguous. It's determined by supply and demand. So at that point, buyers are starting to take over. A lot of day traders, they see these and they see it as an indication that there's going to be a reversal in price movement. And just as a repetition, this shows up after a bearish or downwards move. And of course, this may signal a reversal, suggesting a bullish or upwards change in price movement. Completely opposite to that is the shaven head. So the shaven head shows up after a bullish or upwards move, and it may signal a bearish or downwards reversal in price movement. So yeah, as you can see, there's no line suggesting a high, or the high is actually the same as the opening price, or sorry, the closing price in that time interval. So that might suggest that it has kind of run out of steam. The price has run out of steam, and at that point, it might actually go into a downwards trend. All right, so next we have the dark cloud cover. So this is a suggestion of a bearish reversal pattern. So as you can see here, this kind of has to have two different candlestick bodies to sort of be or go along the lines of this pattern. If you could see a strong white or green body, as I said earlier, between white and black and green and red, the white body, if the white body's mid-segment part is at around the same position as the black body's lower part, that might suggest a dark cloud cover. I mean, as the name suggests, you can kind of see that the black portion is kind of covering the white part, most of the white part. So if you kind of think about it, right? So suddenly at the point or at the red in the white candlestick, it opened at the low price. So as you can see, the lower part of the body, and it closed at the high part of the white body. But then it opened a little bit higher at the top body part of the black candlestick, and then closed all the way back down, almost to the past the midsection of the white body. So this could either mean two things, as you can see with the arrows. It might suggest a congestive move, as I said earlier, with the shaven head, or the shaven bottom rather, or it could just suggest that the price has run out of momentum, and at that point there might be a reversal in price. I would suggest kind of writing out this diagram. It's something that comes up very commonly in especially in short-term trades. And what I also have to remind you of, though, is while these will help you become a better trader, these will not necessarily help you make money right away. Sort of being able to recognize these patterns during specific market climates, that will start kind of telling you, oh, so while we're in sort of a bear market and I keep seeing this dark cloud cover, this might indicate that, oh, it's just a congestive move, or, oh, it has run out of momentum. So this is kind of where the whole idea of varying trading strategies based on different market climates comes in. You should not always follow the same methodology in each market climate. So when you're seeing a dark cloud cover, please do not just, buy into a stock thinking that the pattern itself will determine the price. So this is kind of our last pattern that we're going to go over today. Next week, we're going to go a lot deeper into the candlestick patterns, also into technical analysis, which involves If your parents have ever traded, you might have seen them adding a little bit more than just the candlestick graphs, maybe some moving average graphs, some Donchian channel graphs. This might all sound kind of unfamiliar, but I'll definitely get into that next week. So as you can see here, this is kind of the opposite of the dark cloud cover, right? So at around the midsection of the dark point of the, what is that, the black or red candle, the stock closes at around the midsection of it. So what does this suggest? It might suggest, just like the dark cloud cover, a reversal or change in the downtrend, except the exact opposite. But what the diagram doesn't suggest, however, is that there's an alternative turnout that it goes down rather. But first, the first candlestick body has to be red, indicating falling price, and the second body is green. The stock gap has to open lower than the previous candlestick's low. So you don't really have to interpret this in terms of words. That's kind of why I love, or everyone loves, candlestick graphs, is that you don't have to really memorize which one has to be. I mean, not a lot of people have photographic memory, but just kind of you can kind of recognize, oh, the second body, the green body, has a high or the closing price at around the midsection. Oh, that's actually a very big indicator that there might be a reversal in price. So yeah, always just be in the lookout in these. What you have to remember, however, is that these are more applicable for traders, right? So if you're a long-term investor and if you kind of see this, this should be pretty irrelevant to you, especially when you're only caring about closing prices. So yeah, if this was a line chart, you'd only see the top part of the line of each candlestick graph. What you don't want to see as a long-term investor is a bunch of bodies that are going to be really confusing. It might actually put you out of wanting to hold a position in one of these stocks, considering that's moving up and down a lot. So today we kind of went over most of the traders techniques, but what we will go into, which is called fundamental analysis, if you were in the previous lecture, fundamental analysis is more applicable to long-term investing. All right. Yeah, so just one point I want to leave you guys off with today is that knowing candlestick charts will not make you a good trader. So that's a complete fallacy, knowing that knowing candlesticks will suddenly make you a good trader. The fact is, however, is that your knowledge of specific market details and climate, possession of efficient and quick hands in technical analysis, and a thorough understanding of candlestick pattern trends indicating reversals and etc. will help you to trade well. So that's a mouthful, but basically what I'm trying to get at is that you cannot solely depend on patterns, right? Patterns will help you a lot in determining or making short-term decisions. However, you need to have some idea of the industry. That's also why many people say that if you have maybe a little familiarity with, let's say, for example, cars, you might be actually able to have a higher hand in the automotive industry when trading automotive stocks. So what I've done personally, which we'll get into when we're creating accounts for the Market Watch Simulator, I've actually created watch lists, basically just lists of stocks that I want to review all the time, are a bunch of automotive stocks. So I have about 11 different stocks in there. Some include Aston Martin, which is like a penny stock at this point, Fiat Chrysler Automobiles, General Motors, which is a big one, Ford. So I'll just basically combine all of these into one watch list. And when I'm, especially during times of coronavirus, you'll really see that a lot of these graphs correlate with each other. So that's just kind of one example of your knowledge of market details and climate. Not only that, you'll have to possess efficient and quick hands in technical analysis. So technical analysis, I touched on that a little bit earlier, but the technical analysis part of trading is just creating regression curves that are actually programmed by your computer. So that means that, for example, a moving average would indicate over the past 3 months, how has the price changed, right? Like, so the average, the aggregate combined price over the last 3 months, how much has that changed going from time to time? So let's say yesterday it tracked the previous 3 months from that point. Today it tracked the previous 3 months from today. So we'll get into this a lot, but when we're looking at technical analysis, that will actually really help you for price entry and price exit, along with candlestick graphs. So I'm sorry to disappoint you if you thought that trading would just be a chart analysis game, but really it isn't. I mean, this is all real life here. So a lot of the things that you will learn in this course will be extremely applicable to your future trading. Except what I do want to remind you guys is that knowing these patterns is one thing, as I keep pressing you guys on, but you will also have to look at the news a lot. So what I did say in last week's lecture is that the news is always outdated. However, it will give you a good idea of the market climate. As we mentioned at the very beginning of this lecture, the market climate is very important in determining your trading strategy, right? So without knowledge of the market climate, it's very difficult to make quick, hasty decisions when you're trading, especially when you don't really know, oh, is there an overall downtrend, or am I just looking at this pattern, overlooking it? You might be in sort of a panicked status when you're trying to make this decision. So always, you have to have a good idea before you enter the possibility of holding a position in a trade. So yeah. Thank you for listening today overall. And I think over next week, we're going to go over, as I said, more chart pattern analysis and more into, or an introduction to technical analysis.